Many factors contributed to the collapse first of the Silicon Valley Bank, and then others up to and including Credit Suisse. But what most people here want to know is, will it affect Canada's banking system? For that, we're joined by Laurence Booth, the CIT Chair in Structured Finance at the University of Toronto's Rotman School of Management, and he joins us now here in the studio. Great to meet you. It's great to finally have you in here.
Yes, great to be here.
Okay, we all know BMO, Nova Scotia, Royal Bank, et cetera, et cetera. Silicon Valley Bank, is it different from all of those banks that we know here?
Fundamentally, very, very, very different.
How so?
Most Canadian banks take in lots of little deposits from us, and they make loans, which is, of course, the business of banking. Silicon Valley was taking in very big deposits, mainly from tech companies in California that would go public and raise some money from venture capitalists. They'd get several $100 million, they'd put it on deposit at Silicon Valley. So then when they take all those big deposits, they have to turn around and invest them. And they didn't have enough loans to make, so they put a lot of money in government bonds. So
that sounds like a very safe thing to do, though.
Well, it is, of course. You get your money back, but you get your money back in 3, 4, 5, 6, 7 years' time. So if they put the money in treasury bills, there wouldn't be a problem. But they put them in medium-term bonds, interest rates went up, and the value of those bonds went down. They couldn't afford to basically keep those bonds until they matured because they'd be losing money for 3, 4, 5 years. Depositors got wind of it, and unlike us being protected by deposit insurance, until President Biden stepped in, those big depositors weren't protected. So they ran, and they ran as quickly as just clicking on a computer.
Let's pick up on that, because there is federal deposit insurance in the United States.
Yep, $250,000 US.
Up to $250,000. Knowing that you're not protected after $250,000, why do you bother to keep an account with more money in there, knowing that you're unprotected after $250,000?
That's a very, very good question. The commentary was that Biden had to step in order to make sure these Silicon Valley companies could make payroll. But if you want to make payroll, you don't put the money on deposit anywhere. You put them in treasury bills or short-term securities that you know the government's going to pay you back. So why they would put money on deposit at a bank not protected by insurance is a real big question mark. And why they would put the money in 3, 4, 5-year government bonds financed by these deposits is another big question. Their risk management techniques were basically appalling. So the other thing is that the bank did grow very, very quickly. If you want to grow quickly, you don't grow quickly by taking deposits from people like you and I. You grow quickly by taking in $200-300 million deposits from big corporate clients, and that's exactly what Silicon Valley did.
All right, there was a bank run, right? People start to see the bank's in trouble, so they want their money out, and then all of a sudden the bank is in trouble. Can you help us understand the sort of psychology behind a bank run? At what point do people start to say, there may be trouble here, and therefore I want my money out?
Basically, March is a good time.
Why March?
Because you got annual reports and you got the annual information forms. So they can go through the financial statements, and people started looking at Silicon Valley and said, well, they've got all of these medium-term bonds yielding 1.5%. And look what's happening. Interest rates are going up. And interest rates are going up, the value of those bonds goes down. And the amount of money they have to pay on these deposits goes up, because if you've got $250 million on deposit at Silicon Valley, you don't want 0 or 0.5% interest. Now you can get 2-3% by putting it in the money market. So all of a sudden, these big depositors started looking and saying, well, they're going to lose a lot of money, question number one. Question number two, we can get better money returns elsewhere, so why keep it on deposit? And then question number three was when some reasonably senior people in the tech business started saying, I think we'll move our money safer. And pretty soon, you start moving the money, and then that's when things start getting bad, because they have to start generating cash to pay off the creditors.
Once there is a sniff in the air, though, that something's wrong at the bank, is there anything the bank, a regulator, a political leader, the Secretary of the Treasury, is there anything anybody can say to stop it?
Well, that's what President Biden and Janet Yellen has come out with and saying we'll insure all of these deposits.
But the toothpaste was out of the tube by the time they spoke.
Well, that's right. But then There's concerns, obviously, in Congress in the United States that the regulators were asleep at the wheel, which is a bit unfair because these things, they didn't really anticipate these sorts of problems.
Well, it sounds like management was hugely in the wrong here.
Absolutely. Of interest, and without plugging the University of Toronto or Rotman, after the financial crisis, 2008, 2009, we put a master's degree program in place on financial risk management. And we've been graduating 30 to 40 students a year going into the Canadian banks. So every single one of those graduated, they'll say, how on earth could Silicon Valley do this? It sort of runs counter to all of the basic principles that we teach our students.
Because your grads know better than to allow this to happen.
Absolutely. You don't borrow short and lend long. This has been the recipe for financial disasters in the United States for the last 40 years.
Well, of course, one of the reasons we wanted you in that chair right now is to find out whether what has transpired in the United States could leak over the border. Is there any reason to believe we could be infected by this virus?
The virus is confidence, and confidence is a virus. It transmits. So there's no question that the Bank of Canada will put in place special repurchase agreements so that any of the banks get into any sort of problems with money leaking out, they can go to the Bank of Canada and they can borrow money. So they did that in, probably you remember Bear Stearns, March 2008. Mm-hmm. They did that in 2008. They did it again in during the financial crisis. So the Bank of Canada is on top of this, but I don't think there's a problem in the first place. There's not a problem in Europe either, apart from Credit Suisse. The Bank of England hasn't seen any run on any of the UK banks. So to a great extent, this is a series of unique events rather than being one sort of virus that's affected all of the banking system.
Unique events because these banks in the United States were cowboys in a way that our banks aren't. They assumed much higher risk than our banks are prepared to risk.
That's absolutely true. Yeah. Our Canadian banks are notorious for the banks being conservative, the regulators being conservative, and Canadians generally being conservative.
Turns out that's not such a bad thing when banks go under.
Well, back in the financial crisis period, I said it's the classic case of the tortoise and the hare. And the US being the hare with a broken leg, the tortoise overtakes it. So in periods of crisis, we look very, very good. In periods of expansion, the US looks very, very good.
I gather there's a Canadian subsidiary of Silicon Valley Bank.
Yep.
What happens to all of it?
Well, first of all, it is not very big. Secondly, there's already been a winding up order for to allow OSFI to go in and seize those assets. And there's no Canadian depositors there. It's a small operation. And as far as I understand, it's a branch, not a subsidiary, which means that it's legally as part of Silicon Valley in the United States.
So it's not comparable in as much as our tech companies wouldn't necessarily put all of their resources into this bank.
No, it's not comparable
in that way.
at all.
Okay.
And the FDIC is winding it up in the US.
Federal Deposit Insurance
Yep.
Corporation. Okay. We've got about a minute and a half left, and let's touch on this because I think there may be some confusion about how much the United States government has stepped in here in order to ensure the banking system didn't collapse. And President Biden was at pains to say there's no taxpayer dollars that are going into bailing out these banks. It's something else, so taxpayers don't fret. Can you explain that?
Well, technically he's correct, but the Federal Deposit Insurance Corporation is an agent of the US government, and it charges insurance premiums to insure all of those deposits. So the insurance premiums to insure $250,000 for ordinary people like us are pretty low. If it gets hit with a huge amount of losses, it's going to have to hike those insurance premiums. So it may not be the US government, it's basically going to be a lot of small savers in the United States that effectively, when the banks have to pay higher insurance premiums, they're going to be yet another increase in fees.
So technically, he's being accurate when he says taxpayers are not bailing out the banks.
It's not the taxpayers, but I mean, ultimately somebody has to pay. And it may not be the taxpayers, but it may be the general public in the United States that everybody has a deposit at a bank.
Gotcha. Laurence Booth, great to have you from the Rotman School here at TVO tonight. Many thanks.
My pleasure.
The Agenda with Steve Paikin is made possible through generous philanthropic contributions from viewers like you. Thank you for supporting TVO's journalism.